Okay, so this is a pro forma financial statement, and the first thing we need to do before you complete a pro forma financial statement is to look over the any assumptions your manager boss may give you, or any assumptions that would be listed in the assignment. That's the first thing to look at. So here we have a sales growth of 28%. So we know that sales is going to grow by 28%. And all these categories here are going to grow at 28%. So if they say that they're projected to remain the same percentage of sales, if you were to calculate a percentage of sales, one way to do that is to look at last year's sales and what percentage, say, cash is of last year's sales. And then you can get this year's sales, and using algebra, you can keep it at that same percentage. So maybe it's at actually 9%. But alternatively, if you know that sales are going to grow at 28%, and these remain the same percentage, you could just grow cash by 28%. It's the same difference. So there's really two methods of trying to figure out how much any of these items, if they're going to remain the same percentage of sales between the 2 years, and they're going to grow at the same rate, there's really the textbook talks about two ways of increasing them. One is simply just multiplying it by a growth rate. So if I give you a 28% growth rate in sales, you just have to multiply all these items by that 28% to get the same increase. In some cases, they may not give you the growth rate. You would have to calculate the growth rate yourself. And to do that, you need to form a percentage relationship between two numbers. So if they may just give you next year's sales instead of, so if we go over to the handout, I'm going to put 1.28 to increase it. Okay. They may just say next year's sales will be 32 million. If that's the case, if they give you 32 million and you have last year, and they don't give you a percentage increase, then you would have to calculate it. And that would be simple as the new sales, 32 million minus the old sales divided by the old sales. So then we get 7 over 25, and that equals 28%. So that's how you could come up with the percentage if they give you, if they just give you the sales and not the percentage. But here, they're giving the percent. So that sometimes can come up in a problem. Okay, so we know that all these are going to grow. We just simply increase these by 28%. These items here are not projected to increase with sales. They're projected to remain the same. So we just have to copy the number over from the previous year. Plant and equipment will grow by 5%. The tax rate is 30%. Our dividend is 425%. And the bad debt allowance for next year is 15%. So those are all special cases. And when we're completing the handout, there's also the complication of depreciation expense. This is something that's not related to sales. And we're going to need to take this depreciation expense and add it to accumulated depreciation later. And the same thing is going to be with the addition to retained earnings. We're going to need to add that to retained earnings later as well in the balance sheet. And those are two things that sort of confuse people. So cost of goods sold, if I were to find a relationship between sales and cost of goods sold, I could say cost of goods sold divided by sales gives me a factor of 56%. And so I could either increase, if I was to take 56%, right. So I'm going to also take this and multiply by. Okay, so see how these two numbers are the same? This number, I took the 14 million and I increased it by 28%. This number here, I discovered that 14 million is 56% of 25 million. I made that calculation over here. So I simply took 14 divided by 25 and I got 56%. So that's the percentage relationship between cost of goods sold and sales. So I could use this 56%. Over here, I just multiplied 14 million by, I'm sorry, 32 million by 56%. That's the percentage relationship between the two. But I find it's most easier for students just to multiply by the growth rate of 28%. But the textbook may talk about these two alternate ways. And in some cases on the test, there could be a question that may set you up in a way where they don't give you the sales growth, but they may just give you two numbers. They could give you the sales number and expect you to increase the cost of goods sold using the percentage relationship, not the growth rate of sales. So that's why I just want to point that out. You may need to know that you can do that two ways for some problems on the homework or on the tests. But what we're doing here is we don't have to do it both ways. We're just going to increase it by the 28% because that's a simpler way of doing it. Now, gross profit is a calculation that is just a income statement calculation. So it's just sales minus cost of goods sold gives us a gross profit. Selling administration expense, I believe that's going to increase by 28% as well, correct? Okay. And then operating income, this is simply taking our sales minus our cost of goods sold minus our, actually we already did that, so we could just take the gross profit minus selling minus depreciation expense. All right, so that's the 9,200,000. So that's, again, you don't increase this by a percentage. This is a normal income statement calculation. We only increase the accounts by a percentage, not the calculations. All right, so interest expense, and we said that interest expense was going to stay the same. And that makes sense. If we're not planning to borrow new money, why would the interest rate increase with sales? How is interest rate related to sales? It's not. This is the main concept of this problem, is sales are related to what's called spontaneous assets and liabilities. And they're spontaneously changes with the changes in sales. And that's also frequently a test question. They ask you about spontaneous balance sheet accounts, spontaneous income statement accounts. They may say, which of the four items below is a spontaneous balance sheet account? And they'll list four items. Three of them will be from the income statement, and one will be from the balance sheet. And you have to, or they may list something that's not spontaneous from the balance sheet and something that is spontaneous, and you have to pick out. Helpful hint for the test. I'm sure you appreciate that. Income before tax. I'm going to take my earnings before income. I'm going to subtract my interest expense, and I get my income before tax. And here, there were a lot of questions that you had students when I walked around asked me, well, what's the tax rate? If you look at the assumptions page, you'll see that it's 30%. So on the assumptions page down here, the tax rate is 30%. If you were trying to work off a handout from that was given out in class that said 40% on the other handout, this tax rates can change. It's not always the same for every company. So I wanted, okay. So then net income is going to be our earnings less our taxes, and okay. Nope, I actually did the tax rate wrong. I need to multiply that times our earnings. Better. Okay, is everybody with me there? Okay. I thought that was too good to be true. Okay. Yeah, so the income tax comes off of our current year's income. Just like you will have to, hopefully, paying taxes is not a bad thing. You know why? Because it means that you made some money during the year. So if you have a job, you're most likely paying taxes. And the same thing for corporations. Okay. Now, stock dividends paid under the assumptions paid page, they give me the dividends right here. That's what we're paying. And dividends are something that they're not directly related to sales because let's format this. Because the management of the company decides what the dividends are. Now, increasing sales does help because if that increases profits, then you have more money to pay in dividends. Now, in retained earnings, income can only be dividends and earnings. So if I have my earnings here, and I subtract away my dividends, I get my addition to retained earnings. So when you have net income, like we know from earlier chapters, chapter 4, there's only two things we can do with it. We can pay it as dividend or add it to retained earnings. Okay. And then the earnings per share, we're going to take our net income and divide by the amount of outstanding shares, which here is 1 million. Okay, $5.50 would be the earnings per share. So a nice improvement in earnings per share. This should actually be handout D. All right, so let's move on to the balance sheet. Okay, now cash is projected to increase at the same percentage of sales. Okay, so let's see what else we have. We have cash, marketable securities and accounts receivable, inventory, prepaid expenses. So I'm going to increase all these by 28%. Now allowance for bad debt is different. That's something that we're going to set. We're not going to increase it at the same percentage of sales. We decided to only increase that by 15%. Or is it 10%? Okay, 10% then. Okay. So 10%. All right. 10%. And then accounts receivable net. This is just a quick sum of these two accounts. One, we're going to less the allowance for bad debts. And then inventory. Again, inventory is an increase, and so is prepaid expenses. Hold on, did I make a mistake? Let me just double check. Yes. I'm making all the mistakes that you guys usually make in the test, so I'm making them for you. All right. Nope. Better, much better. Okay, so let's just reiterate that. The allowance for bad debt is stated here in the assumptions as 10%. So that's 10% of the current year's accounts receivable. And you'll notice that over here, this percentage over here may be different. So if we do a quick calculation, we see that it was 15% in the previous year, but this year we're lowering it to 10% of the current accounts receivable because maybe we feel the economy is better, our accounts receivable collection practices are better, our using of credit scores as such may have improved the quality of our people who we're lending money to. All right, so this gives us our current assets, and that looks to be about right. So we have our cash increased 28%, marketable securities increased, accounts receivable increased. We're taking a 10% of bad debt allowance for accounts receivable, calculating a net of the two. Inventory is at 28% increase, so is prepaid expenses. And to get the total current assets, I'm adding up cash, marketable securities, and I'm also adding accounts receivable net, inventory, and prepaid expenses. I'm skipping these two in gray. I don't put these in my calculation because there's a sum total right here. Okay. Plant and equipment. Now, in the assumptions page, they're assuming or planning a 5% growth in plant and equipment, which is not related. This is not considered, in this example, to be considered spontaneous at the same level as sales, but we have on the plans increase it by 5%. Okay. Now, less accumulated depreciation. So we have to figure out what this is a tricky one. So accumulated depreciation, we're actually going to go back to our new depreciation expense up here, and we're going to add to that last year's depreciation. Because depreciation is something, whenever you see accumulates, that means that we're going to keep growing that number. So when we depreciate our assets, we don't get back last year's depreciation. It stays depreciated. So we're only adding to it. So that's why this accumulated depreciation is different than most of the other cells we worked on before, because we have to add our depreciation expense from the income statement to accumulated depreciation. So net plant and equipment is just going to be we can take our plant and equipment, subtract out our this is never helpful. Okay, so our total assets, we're going to add our plant and equipment to our current assets to get our total assets of 73 million. Okay, so now we're going to move on to our balance sheet. Okay, so accounts payable. Let me check our assumptions. And accounts payable, accrued expenses are going to grow at the same rate, but notes payable, long-term debt, common stock, and equity of par, and interest expense will remain the same. Okay, so knowing those assumptions, I could grow this account I can grow by the 28%. Notes payable is going to remain the same. Accrued expenses will grow by 28%. So our total liabilities bonds payable will remain the same. So if we calculate our total liabilities, my long-term and short-term debt together, I get 53 million. Okay, so capital excess of par. What capital excess of par is, it's an accounting sort of stipulation. This is money that investors put into the company that's above and beyond the stock. So actually, let me reverse that. That's the capital excess and par is what I just described. This is par value of the stock is always not, it doesn't have any relationship to the real stock price. So the par value of stock is an accounting stipulation, and they're stating it at $1 per share. So that's $1 million of par value of the stock. That's just an accounting rule. The capital in excess of par is the money that they paid beyond the 1% of par. So here it tells me that investors paid $6 a share initially when the stock was first sold. And that's the money that was raised by that stock. Since we're not increasing capital in excess of par or common stock, we know that we haven't issued any additional shares of stock. Those are remaining the same. But there could be a pro forma financial statement where they say we're issuing another 100,000 shares of stock at $15 a share. And that would be added to our capital in excess of par. Okay, so retained earnings, again, we're going to take last year's retained earnings, we're going to add the addition to retained earnings to it, and we get a new retained earnings of 11 million. So our total equity is going to be our retained earnings plus our capital excess of par plus our common stock. And we're going to get 17 million, and then our total liabilities and equity, we're going to add our equity to our total liabilities, and we get, that's not right. That's better. Okay, so you get 71 million. Now we see that if we look at our total assets minus our liabilities, we see that total assets are about $3 million more than our liabilities. Why are our assets more? Because we're increasing cash, we're increasing marketable securities. We're actually, is that something we're increasing marketable securities. We're increasing accounts receivable, inventory, prepaid expenses. So when we increase all these assets, that can come, part of that can be paid for through our profits. So our addition to retained earnings can pay for most of that, but of the increase, it fell short about 3 million. So this would mean that we have some additional funds are needed, and maybe if maybe I think I have to do the calculation the other way. So additional funds are needed of 3 million. Don't worry about try not to get hung up or plus or minus signs. Just know that if the assets are larger than the equity and liabilities, you have to get additional funding or additional capital, either issue new stock or issue long-term bonds. And if assets are lower than liabilities and equity, you have a surplus, which means you can go ahead, if it was a simulation, you could go ahead and buy more assets. So let me just, if I was to correct this, I could no, maybe I issue some more long-term debt. And if I issue more long-term debt, I can use that to pay for my assets, and excluding, I guess, the extra interest charge, we could get our balance sheet to balance. So that's the whole idea of this pro forma financial statement, is to see where we are as a company. Do we have to take out additional financing? Or are we going to be so profitable that we could plan for additional assets? And that's sort of the whole purpose of this. Okay.